All right, let's talk about one of the biggest decisions you'll make as an investor. Should you be hunting for that next breakout stock, or is there a simpler, more reliable way? Today, we're going to look at the hard data behind stock picking versus index funds to see which path is really the best one for building wealth.
So here it is, the billion-dollar question. Can you, or anyone for that matter, consistently beat the market? Is it actually possible to find those hidden gems and do better than all the pros on Wall Street? You know, this isn't just about numbers. It's really about the thrill of the chase versus the quiet power of patience. Let's dig in.
And this really is the heart of it, isn't it? The investor's dilemma. It's that first big fork in the road on your journey to financial freedom, and you've got to decide which way to go.
Think of it like this. You've got two paths in front of you. One is the high-stakes, exciting path of picking individual stocks. The other is the slow, steady climb of index funds. Now, both are aiming for the same destination, wealth, but they could not be more different.
Now, let's talk about that exciting path first, the thrill of stock picking. And come on, let's be honest, the idea is incredibly appealing, right? It's the story we all love to hear, finding that one amazing company before anyone else does and just watching it take off.
So what exactly is stock picking? Well, it's basically the art of betting on specific companies. You have to become a financial detective, right? You're digging through reports, you're tracking the news, trying to find the winners, all for one goal, to beat the market average.
And make no mistake, it is a high-stakes game. The reward? It could be absolutely massive. I mean, if you get it right and find that next game-changing company, the returns could change your life. But the risk is just as big. If you pick wrong, you could lose a huge chunk of your investment. It's a very concentrated bet.
Okay, so if stock picking is the high adrenaline gamble, what's the alternative? Let's switch gears and talk about the wisdom of index funds, because this strategy is built on a totally different philosophy.
Here's the beautiful thing about an index fund. It doesn't try to beat the market, it just aims to be the market. When you buy a fund that tracks, say, the S&P 500, you're buying a tiny piece of the 500 largest companies in the US all in one go. You're not trying to pick the winning horse anymore, you're just betting on the whole race.
So let's just break it down side by side. Stock picking is an active, high-effort strategy where your risk is very concentrated. Index funds are the complete opposite. It's a passive, low-effort approach where you're just betting on the whole economy, and your risk is spread nice and thin.
Okay, so we get the theory behind both, but you know, theory is one thing. What really matters are the results. So what does the cold, hard evidence actually have to say about this? Let's look at the numbers.
And this really puts the challenge into perspective. Just think about it for a second. There are armies of professional analysts out there with billions of dollars in resources who dedicate their entire lives to trying to beat the market. And the data shows that, well, even they usually fail.
And here it is, the killer statistic. Over a 15-year period, around 90% of professional fund managers, these are the people paid millions to pick stocks, failed to do better than a simple, low-cost index fund. Let that sink in for a second. 9 out of 10 professionals can't beat the average.
In this chart right here, it shows you exactly what that 90% figure looks like in practice. Over the long haul, you can see that the steady, reliable growth of a simple S&P 500 index fund consistently comes out ahead of most of those funds that are actively trying to pick winners.
You know, it's not just about the final numbers either. What this data doesn't show you is the hidden cost of stock picking. We're talking about hours and hours of research, the stress of watching your money go up and down, and the incredible emotional discipline it takes to not panic and sell when things look bad. So how does all this tie into the goal of FIRE, financial independence, retire early? Well, the whole FIRE movement isn't about some risky, get-rich-quick scheme. It's about building wealth in a systematic, reliable way so you can take back control of your time and your life. And this is exactly why index funds are pretty much the bedrock of the FIRE strategy. They give you instant diversification, which means more stability. They let you capture the growth of the entire economy over time. And they give you a predictable way to build wealth, all without the stress of trying to pick individual stocks.
All right, let's bring this all together. What does this actually mean for your own investing strategy as you work towards your financial goals?
So if there's one thing to take away from all this, it's this. The data is overwhelmingly clear. While hunting for that next big stock is exciting, the most proven path to long-term wealth isn't complex, it's simple. It's choosing the steady, reliable power of the entire market. So I'll leave you with this final question to think about. When you look at your own approach to investing, just ask yourself, is my strategy built for excitement or is it built for wealth? The answer to that question will tell you everything you need to know.